So let's get started with it immediately. First of all, first basic, S&OP, IBP, that kind of process. There's a lot of talk about it. It already exists for something like 30 years. It is in the title, Strategy-Driven S&OP. So what do we actually mean with that? And what are the building blocks of that S&OP process as such? Well, one of the cornerstone elements in S&OP, sales and operation planning, by the way, is planning your demand or your sales. So that would be one of the blocks that we depict here in a cycle that we probably iterate on a monthly basis, and part of it will be iterated maybe on a quarterly basis, and other processes will be more on a yearly basis, but we'll get to that later. So in any case, one of the major or primary building blocks in sales and operation planning, a process where we are going to connect the strategy of the business with the operational level through a tactical level. One of the major building blocks is your demand planning part. Collaborative demand planning, statistical forecasting, support, that kind of thing. That's what we want to achieve over there. What is out there? What are the expectations? And also, what are the ambitions and the possibilities? Customer facing demand. Another part, of course, if we look at sales and operations planning, is the supply part, the operations part, everything that we can achieve and our capabilities in providing the goods that we think we can sell in our demand plan. That's the basic essence of sales and operation planning, balancing or trying to find the balance between a demand plan and my capabilities in my supply plan. If the balances are not entirely achieved, if there are a number of imbalances that we need to escalate, then there's a process for that, or at least a meeting for that. And in that meeting, we want to escalate it to our executive level, executive S&OP meeting, and ask them what do they think is the best solution by providing them a number of scenarios that can fix the problems that we find in balancing out our demand and supply. Okay, that in essence, on a volume basis, on an aggregated level, a tactical level, is the minimal, let's say, objective of something like sales and operation planning. There were a few smart guys over there that said, yeah, but you have your demand and you have your supply, but we have something new in there. We have SIOP, we have sales and inventory and operations planning, because it's also something that we should target and have a good feeling of and good objectives at. That's absolutely true. So we also put that inventory part in our cycle as a target setting, as something that needs to be properly monitored to be able that our balance is also properly managed. Okay, so that's a small extension, but to my mind, you can't have a demand and a supply without an inventory, and vice versa. Then came in something like integrated business planning. Integrated business planning with a number of additions actually to this already existing S&OP cycle. And one of them being, we also need to include the product management or the product managers or the marketing managers into this process, because they have vital information on phase in, phase out of certain products, what kind of ranges of products they want to work on, what kind of ranges of products they slowly want to let die out, and so on. So if we can't include that in our cycle, they may come in and disrupt the entire planning that we already have provided or set up. So that's one part in the integrated business planning that is popping up. Another one is that we also want to not only talk about volume, but we also want to translate it one way or another to value, because value is something that is much more adopted when talking about business and business strategy than volume. Yes, we need to have both. So that's the first step, and by doing that, we also want to extend the number of functions that we are including in this process throughout our entire company. So we are looking to finance, but we're also looking to marketing, as said before, HR may be coming in the equation, and so on. Integrated business planning. Yes. From our side, you can see that there are still two blocks open there. Well, the first one here is what we call the customer product segmentation part. Because we firmly believe, oh, that's not so nice, but you can see CSP, customer product segmentation. We strongly believe that you will not serve every product to every customer in the same way. And another thing is, if you can segment your portfolio, you can attach different services to it, whatever service may be, which translated properly through your technical level will also enable your operational level to properly execute the plan as foreseen and to make proper decisions without escalating it every time to the executive level. That's why we add customer product segmentation to the equation. And then you can see there's still a shape in the middle of this cycle here on my slide. Well, it looks like a triangle, and actually that's also how we call it, the supply chain triangle, which brings us to basic number 2. Basic number 2, supply chain triangle. Well, it's a nice triangle because it has 3 corners and a center. And let's look at the different elements that we want to illustrate with this supply chain triangle. One of the elements, and that's the top element, is what we call service. Service, actually everything that is, let's say, the outwardly face of our company, everything that goes to our customers. So that's portfolio, that's price, that's order flexibility, it's all that stuff together. And in essence, this will create my revenue, yes, my top line. That's what we are looking at. Another part on the triangle, or another angle on the triangle, is the cost side, which we typically put here. The cost side, everything related to your operations, such as warehousing, logistics, production, purchasing, and so forth. Yes, very well known in most companies. And actually, the service minus the cost will bring us to the bottom line. If this would be the top line, this will be the bottom line, and in between we would have things like margin or EBIT to make it easy. So that's what the supply chain triangle is showing us already. The next one, or the last corner, would be the cash side. Cash side being, what are the working capital requirements that I need to be able to fulfill all these operations and to support them. A little bit like the oil in the machine. Yeah. And one of the major parts here would be inventory. Inventory in your working capital is typically a big portion of that, and also your fixed assets. Now, that brings us to a kind of balance that we need to look at every time we want to make a certain decision in our supply chain. For instance, if I want to extend my portfolio because I have the ambition to generate more revenue, it will have a certain impact on the cost side and or the cash side. Probably when I extend my portfolio by I don't know, extending the milliliters, the content size of certain bottles in which I ship my product. Well, I probably have an impact on my inventory levels because I need to store the finished goods, but also some of the intermediates and maybe some raw materials. I will probably also have a negative impact on my cost side because I need to purchase those raw materials, but I also need to change over much more often my production lines. Those two negative impacts together may easily completely annihilate the positive impact on the revenue side. So that's a balance that we always need to keep in mind. We need to look at that. We need to assess it. And one of the ways to assess it is what would be in the middle. It's a financial metric, and it is called the Rosy, return on capital employed, which brings us, yes, to our third basic of strategy-driven sales and operation planning. And let's move this out. The Rosy. How does that look like? Well, the ROCE, in essence, is your return on capital employed, but I'm going to use the abbreviation now. Return on capital employed. What would that mean? It actually means that if I invest $1 or €1, what do I get out of that investment? A little bit like return on investment, yes, that one, ROI, but with a number, with an additional number of elements in it, to my mind. The top side would be, what's your profit? Yes. Your profit would typically be the difference between your revenue, remember that top line, minus the variable costs, minus the fixed cost. Yes, that together could be your revenue or your profit or your EBIT. I told you about the cash side, the working capital requirements or the capital investment, which is the fixed assets, but also your working capital requirements, and a big part of it is your inventories. Well, the oil in the machine is below in the equation. So if we put the one over the other, we get a kind of turnover metric, return metric, sorry, and then we get the return on capital employed. Meaning, I can, like in the former example, I can increase my revenues, but if to increase those revenues, I need to heavily invest in inventories, and I'm also, for instance, heavily increasing my variable costs, it might be that in the end, this Rosy is not going up or staying steadily the same, but is going down. And if the Rosy is going down, then probably we are not really achieving our main ambition, or we are not in line with the strategy that we want to deploy with our company. Which brings us to our fourth basic. Strategy. How many companies out there have this kind of strategy poster on top of, I don't know, the counter or the sink where the coffee machine is and so on, or in a meeting room, and it goes a little bit like this. We have the customer service on top of our mind while delivering them the highest quality innovative products in the most operational, efficient way. Now, those are three different things in one statement. And the difficulty there is that actually you have not chosen. And let's look at this. This is a Tracy and Wiersma model. Yeah. And they make the distinction between three ways to go to the market, three ways to make yourself different than your competitors in the market towards your customers. Yes, and one that is very well understood is the operational excellence part. Yes, making sure you're not generating too many costs, making sure that everything is delivered in a very efficient way. That is one of the ways to make sure that you can be beating your competitors in the market. Think, for instance, the discount retail companies. They are very strong on that. It will be in their DNA. It will be in their culture. Every day they will think about how can they cut some of the cost, how can they better deliver everything, how can they be more efficient, zero defect and all that kind of stuff. That's those guys over there. Other guys could go for the product leadership. The product leadership part would be something like, you know, the Apple iPhone when it first emerged so many years ago. You have something and nobody else has that. So it will attract customers to you if it's a good product. It will attract customers to you any which way you want it. For the mere specialty that you have put in it. Now, to be able to do that, you need to put a lot of money in R&D and innovation and technology and all that. But that means that on the other side of the equation, it doesn't matter that much if maybe you spend a bit more on, let's say, your inventory or heavy assets, because they will be rewarded by being able to sell your products at a premium price to your customers. Yes. Customer intimacy is a third way of going to the market. And with customer intimacy, you actually don't want to be the best in operational efficiency. You're not going to be the best in selling a separate product that nobody else has, but it's a total package that counts here, like IBM has been doing years ago. We can deliver you this, we can deliver you that, but we are a one-stop shop. So once you get engaged by us, you're pretty sure that we will cover all your needs, and we also understand your needs. Yes. Main thing is, we very often hear that many companies want to compete on all of these axes at the same time. And I can understand that because we need to be viable, or we need to be at least capable in every of those axes. Otherwise, we don't have a company. But that would be this threshold over here. Yes, there's a point that we need to achieve just to survive as a company. But then there is this leader thing. Yes, what makes me special? What makes me standing out against my competitors? What is the choice that I make? Well, that would be one of those axes over there. And too often I see companies, yeah, ending up somewhere, well, in between. Can I be there, or can I be a little bit there, or maybe sometimes we're there and maybe sometimes we're there. Now, I understand that, but I also hope that you understand that it will make it very hard to have consistent decisions in your entire company, from your operational to your tactical to your strategic level and back. Yeah? And actually, that is something that we want to try and achieve by S&OP, IBP, or strategy-driven S&OP. Let's have a little look, or a little more detailed look on how these choices can impact for instance, your Rosy. Yeah. Strategy and Rosy. Okay, now this is the Rosy completely filled in. And let's assume that we want to achieve the same kind of Rosy from a product leader perspective or from an operational efficiency or excellence perspective. Operational efficient, like in commodity or in discount, let it be clear that this part they try to minimize for the simple reason they are competing on price. So the price will not be high. It will not be a premium price. Yes. So to have something left over here on this part in the profit, they need to lower the cost. So let's say the cost will be like this because this will only be the price. On top of that, the oil in the system, like for instance your inventory turns, it cannot be too high either. If you want to run a very razor thin margin by having a very low inventory turn, for instance, then probably you're investing way too much money and you're not getting out enough of that money as an objective, meaning your return on capital employed would be quite low. Yes. Now let's assume they have this managed properly, and this ends up in, say, a return on capital employed of 10%. Yes, there will be targets on margin, there will be targets on pricing, on revenue, on top line, and there will be targets on things like inventory turns and so on involved in that company. Yes, to steer them and to keep them in the direction of operational efficiency, a price leader, for instance. If we compare that with a product leader, well, the game may be entirely different. The top line of the product leader may be, let's say, in comparison, way higher, for the simple reason that they can sell their products at a premium price. Yeah? A Nokia and an iPhone have a completely different price. So it might be that I can uplift my revenue, which allows me also to generate a bit more cost to achieve that revenue, because in the end I will be able to generate a different kind of margin than when I'm an operational efficient company. I can also allow myself probably to carry some more inventory, to have lower inventory turns, for the simple reason what I want to support is that product leadership. I want to give a premium product, a premium experience to my customers, and I will ask a premium price for that. I don't want to endanger that by squeezing out all my inventories or by looking too much at certain costs. I want to be sure that the quality is and the experience is exactly as promised. The balance in the end could be exactly the 10% again. Yes. So achieving the same ROCE by achieving the same ROCE by different investments is actually certainly possible, but we need to be able to set those targets in a way that we also have it in line with what is the kind of company that we are running today. If we want to apply operational excellent targets, for instance, for inventory turns, to a product leader, we might break the story. The reverse is also true. We will never generate the margins that a product leader can generate by in a commodity market or something like that. So if that's the case, then we need to be operational excellent. If we need to be operational excellent, we need to cut down on cost and we need to cut down on working capital requirements. Yes, I hear you coming. Why am I not a product leader with the same efficiencies as an operational excellent company? Then I would have a double whammy and I would be able to increase this from 10% to 20%. Well, I'm not saying that's not the case. I'm not saying you cannot do that, but you need to properly manage that. You cannot change the nature and the culture of your company. You cannot view or benchmark yourself against operational efficient companies and then apply it to, for instance, a product leader company, even if you're in the same industry. Think, for instance, fast-moving consumer goods, branded versus private label, those kind of things. The private label is probably way more in the operational excellence part. Branded can maybe be more in the product leadership part. If that's the case, then you cannot switch the metrics from one to the other. You cannot benchmark against each other because you're both in fast-moving consumer goods. No, you're a different company altogether. I hope that's clear, more or less. So bring it all together. What have we seen? There is this classic understanding or concept of sales and operation planning. We want to connect different functions, different roles, different domains within our company from an operational, tactical, and strategic level by looking at demand, supply, inventory in between, escalating procedures, scenario management, and so forth. Including our product management or our marketing ambitions and objectives, and maybe including also some customer and product segmentation to be able to steer some of the decisions more properly without having to escalate it every time. That's more or less what we saw. We also saw the supply chain triangle, where we see that service, cash, and cost are connected to each other. I can optimize on one side, but it will have an impact on the other side. I always need to be able to assess the final outcome of such decisions and make sure that there's not too much tension in that triangle, but that is supporting each other by looking at the Rosy. Supporting each other, it means, yes, it may be that I need to put away more inventory than I was officially targeted at, to support reaching out to a new market. But you cannot fight the battle at every corner of the triangle forever, because it will break. Which will also bring us to what is actually a strategy. Is there a strategy that we want to look at, that we want to pursue, and that we want to be the face of our company? And if so, how do we translate that through some metrics to our operational level and our tactical level? That's actually where we want to get at, and that's strategy-driven S&OP. And there's different layers in the planning. Yes, let's look at the sales and operation planning layer first. Maybe that's easier. Sales and operation planning, typically, let's say something like 8 months out. That would be S&OP. Looking for the imbalances between demand and supply on a tactical level, on an aggregated level. Where do we run into if we want to provide this kind of volume to the market? What are the problems that we may face if we compare it with the capabilities of our supply, of our replenishment, and so on? Yes, that would be your typical sales and operation planning level. A sales and operation planning level on the tactical horizon, to support or to communicate maybe with your sales and operation excellence, execution level on, let's say, a 12-week horizon. Yes, that's all the scheduling, the master production schedule, and that kind of stuff, the master planning, the day-to-day operations, far enough to reorder, for instance, raw materials, that kind of stuff, to install an extra ship for a very brief period. That's your sales and operation execution level, which should be fed by your S&OP, there where major disruptions are, or major imbalances are perceived and mitigated, but which should also be able to, in essence, resolve a lot of the conflicts on an operational level by itself. Yes, that's what it should handle. Order management and all that, it should be on your S&OE level, just to make the distinction. A very famous input to your S&OP, to your demand plan, but also to not only to your demand plan, but also to, for instance, the objectives of how many inventory can I carry and that kind of stuff, is a financial plan or the budget. And typically, the budget would be 12 months, 1 year. Yes. Oh, let's see if I can. Yeah, that works. So the budget, typically 12 months. Very well known, very often an ambition in many companies, an ambition that is out there, that is completely disconnected with your S&OP, and very often also completely connected with your strategic plans. Why? It is managed, monitored, conceived by a different function, your finance department. And even though IBP, integrated business planning, says you need to have a translation from value, from volume to value, that volume to value translation is very often something that goes through some standard costing and maybe some promotions and so things like that. But the thing is, it lacks a kind of real life connection with how your finance people view your company, balance sheet, profit and loss statement, that kind of stuff. Yes, so that's why very often we see there's a lot of tension between what are we working with in, for instance, an S&OP level demand plan, and what is the budget that is out there that we are supposed to achieve. Yes, that's where we very often see the disconnect. Yes, okay, I come back to that. Then there's the strategy part. The strategic part, or the strategic plan, well, we're looking 2 years over there. Yes, 3 to 5 years probably. And if you look at the strategic plan, maybe we want to have a breakdown of that vision of what is our company. Is it a product leader? Is it a is it customer intimacy? Is it operational efficiency? Do we compete on price? Do we compete on access? Do we compete on experience? What are we actually competing on? Maybe we can even segment that in our customer and product segmentations. Yes, over the years you will have reviews of what are the products that we want to deliver to what kind of customers, and in which way, and with what kind of service, and are we going to try to grow that segment, or are we going to divest that segment? Are we going to outsource this part, or are we going to really play the battle on that and win the competition over there? Is it a new product that we are launching, or is it a product that we are phasing out, and so forth? Yes, and to steer that, you also need to have some benchmarks or some objectives in place, and that would be that Rosy. And that Rosy would actually be the proper balance between how do I get my EBIT, remember, revenue minus costs, what kind of service do I supply, on top of my capital investments. And what am I prepared to carry, for instance, like inventory, or what am I prepared to invest in fixed assets to be able to generate that EBIT? Yes, those two elements can be linked via the supply chain triangle to things like price point and so on, to things like service, to things like OTIF, but also to things like cost of goods sold, and so forth and so forth. They should define the balance to support the direction your company is going to for different segments in your company of customer and products. Yes. Once we have that in place, or once we have those different levels defined, we can make sure that they start communicating back and forth. And actually, the S&OP level is a good way to start from. Yes, it can generate bottom up or top down some of the objectives or some of the targets and so on that you can follow up on a monthly basis and even on a daily basis. Of course, they will need to be reviewed on a yearly basis or whatever, whenever you are redefining or reassessing your strategy part. In essence, I think there are a few misconceptions, or there, well, maybe not misconceptions, but there's sometimes some confusion on, yeah, on what level is S&OP, how far out is S&OP, how far out is IBP. Sometimes I hear S&OP is only until 3 to 4 months and everything beyond is IBP. As soon as I monetize my forecast, I'm in IBP. And so on. I hear very different things there, and very different, or in a number of conferences, a number of presentations, it goes a little bit left and right. And some of the questions are always like, what level do we plan on? What level of detail and what horizon? And I think this one is making it a bit more clear, at least our vision, on what are the horizons and the different plans and the different questions that we need to look at. So you have your operational level, day-to-day monitoring, scheduling, ordering of raw materials, that kind of stuff. You have your S&OP, the tactical level. It should be the communicating vessel actually with your strategy and so forth. Your finance, your budget should be really included in there. It should not be a separate plan. And getting all that together in one system, getting all that together in one calculation, in one effort, that is exactly what we aim at with strategy-driven S&OP. Which brings me to the last part. Why bother? Why is it important to have something like strategy-driven S&OP in your company? Not just S&OP or IBP or whatever. Why do we want to evolve? There's a level of maturity that we look at, and why do we believe that this is stronger or yeah, innovative, or maybe putting a few more elements in the equation that otherwise are sometimes forgotten? Well, we want to tackle we want to avoid doing things, duplicating things. Yes, like the financial planning and so on. We still see that it is very often quite disconnected, or an objective that is put there year after year, and then we try to do all kinds of stuff to achieve that objective, or to explain why we are not able to achieve with a different plan and with a different calculation. Calculating your inventories from a supply chain perspective is sometimes entirely different than calculating it from a finance perspective. So that's also one of the reasons. That's one example where we want to avoid duplicating the effort and be sure that we are talking one language, speaking one language, and going for one set of numbers. You know, that one plan. Another thing is, if you do all the effort to define a strategy for your company, another strategy with all the 3 elements in there, like customer service and innovative products and very operationally efficient, but a real strategy, a real vision, like this is where we will go. And if the customer needs to make a choice between 3 companies that are more or less doing the same kind of thing as we are, then they know that if they come to us, they will come to us because we offer them the lowest price, or they will come to us because we offer them the best experience, or they come to us because we offer them the entire range of products that they may need to fulfill their desire. Now, if you have done all that, you have your strategy, you have that vision, then you need to translate it down to the operational level. And to translate it down to the operational level, well, some poster, some statement somewhere in a meeting room or on a slide deck or even on the desktop of your laptop, of your company laptop, will not cut the chase. You will need to be able to set a number of targets, a number of KPIs that are really directing your operations to that level. Being able to do so, I'm not going to say it's easy. You have to make a number of choices. You also have to have a kind of discipline to not chase every forecast accuracy error or things like that, but to go to the overview, to keep the overview on If I look at all the things that are happening today, am I still fine if I look at it from a return on capital employed perspective, for instance? If that is still okay, and that is still the balance between EBIT and capital employed and those kind of things are still okay, then maybe I should not bother too much about the fact that there's a decrease in my service level last month. Yes, if that keeps on happening, of course, and it starts it starts putting some risk on keeping your Rosy, for instance, in line, then there's a moment that you should start reacting, but not every time. And we believe that too often, even on executive level, there's too many discussions on what has happened and what we typically call the diagnostic metrics. What has happened? Why did it happen? Instead of, yeah, it happens. Will it affect the things that we are doing? Yes or no? Same for scenario management. Will it affect? Will it help us by increasing, for instance, forecast accuracy? Or is it actually something that we are chasing, but in the end will not support our final goal, being following our strategy and making sure that everyone in the company and all operations and all systems and all targets are actually aligned to that same objective. This is in a nutshell a number of the basics of strategy-driven S&OP. There's way more to say about it. There's way more to say about, for instance, the metrics that you can put in place. There's way more to say about how do I define actually strategy, because this was a very simple model. Of course, there's way more to say about how does demand planning work? How does inventory planning work? How does supply planning work? How do we do scenario management? How do I install a customer product segmentation in the proper way? I know that, but just to put some elements on the table so you can combine them and get a better understanding of strategy-driven S&OP, I hope this webinar on the crucials already helped you along the road a little bit. Which brings me more or less to the final part of the webinar. If you have any questions, there should be this kind of box in your GoToWebinar session. Feel free to type in a question. I have someone to help me and read them out, and we will pick a number of questions and see if I can give you a kind of answer on that. Yes. Well, tips and tricks. I have a few examples that can maybe illustrate it. As long as finance is looking at your company's objectives in a different way as what is happening in operations, and as long as finance is actually, I don't know, the very strong power in your company, you will be in for a tough ride, because they will, in their financial plan, yes, they will set targets in money, not in volume, for your operations and your demand. You can look at it from a euro perspective, but in the end, you need to hand over a volume, a quantity to your operations. Otherwise, they will not be able to work with it. Yes? Telling your operations that they need to produce $1,000 worth of goods a day is probably not the way to go. So I think the crux of the story is, how do we get from that to that? Yes, that's one thing. There's a translation, no, from that to that, from euros to volume. That's the first thing. A second thing is, and I think that's where most of the frustration is, or the challenges, is what do I do with ambitions? What do I do with growth targets? And very often I see that they are just inside that one number. Yes, last year we did this. This year we will grow by 10%. That's what we think from a finance perspective, or that's what we have put ourselves as an objective, as a target by the CEO or whoever involved. So maybe it's not even an expectation, maybe it's just a target, a push to go, to go further, to go the extra mile. I think it is very vital to make that distinction, because if I'm looking at my demand plan, I am trying to look at what do I expect to sell, and not like what do I want to sell, or what do I need to sell, or what do I need to achieve in a volume perspective to be able to generate the euros to finally achieve the budget imposed by the board or by finance. Yes. So part one, communicating. Part two, so getting them into the process. Part two, making a difference between what do we see is happening in the market, and two, so what is my demand plan, what is my forecast actually, and what is on top of it the ambition that I try to achieve. Having the right metrics and translations in place, and getting them in from the start is probably the only way to be sure that this keeps on being aligned as much as possible. I'm not against setting ambitious targets. I'm not against finance or financial numbers or whatever there, but I think it should be more a bottom-up reporting, and then reassessing whether we are able to achieve those ambitious targets, than just a bottom-down monetized forecast, which in the end can really generate a lot of very wrong decisions on the operational level. And demand planning, you have unconstrained demand, you have your there's a lot of things, constrained demand and so on. There's a lot of things that you want to put in there, but in the end you want to make sure that you prepare your operations on what they will need to do. Yes. You need to have that consensus, and if in that consensus there's this 10% extra mark, well, that's all very nice, but then everyone also needs to be sure that we will sell that 10%, because if it's just out there in the forecast, I may be producing it, but if this was too ambitious, just an ambition out there, I might be sitting on my inventory for a long time before realizing that, by chasing an ambition that is not there. Ah, that's a good one. S&OP, strategy-driven S&OP, and so on. One of the things that we certainly see as an evolution is that supply chain, yeah, is becoming way more important as a role, as a function in running companies. You know, therefore, we also see the rise in a chief supply chain officer role. Yeah. But supply chain, not merely from an operational point of view or function or domain, but also from an understanding of the financial impact of all those operations. Yes. So there should be a strong link with finance. So probably the CFO should be involved in as well, because if we look at that Rosy and those strategic targets by benchmarking and so on that we look at, it's about that EBIT, and a part of that EBIT is also the costs, and of course, what do we generate per revenue, which is very often the focus. These two are very often the focus, but also the capital employed. And if there's capital employed, working capital and cash involved in the process, well, I hope there's one person over there that is managing that, and that should be your CFO. But he should not only be chasing, let's say, investors and shareholders or whoever. He probably also should be able to translate that in a balance that is healthy for the company. Yes. So getting some understanding of supply chain to them is primordial. Now, that does not answer the question yet on who should own S&OP. Well, in my mind, the owner of S&OP is your CEO. The final sponsor, the final stakeholder is your CEO, shareholders, and supported by the CSCO and the CFO. Not your salesperson, not your CSO, not your CMO, not your COO, to my mind, but more these two guys. They should be able to support that. Easier said than done. And yes, I know there are some arguments out there to put it under the umbrella of, for instance, the CSO. So it's not a supply chain thing anymore, S&OP. And I do understand that. Yes, I do understand that. But if you're looking at it that way, I think you're putting supply chain way too much on the operational level. Yes. A real CSO, to my part, with the understanding of the financial impact and so on, should be able to connect all these roles to support that strategy. So, short answer, CEO, who should be monitoring it and should be supporting it, CSCO, CFO, and maybe some CSOs out there. Very important first is, does everyone understand where you are currently? Because if that's not even the case, then that would be the first step. And who would be doing that? Well, depends on the way your organization is structured. Are you centralized? Are you decentralized? Are you global with many regions? Or I cannot answer that. There's no one size fits all answer there. But certainly, first is, if you have a current process, is everyone completely aware of what it is doing and what it is not doing? And are all the expectations there? Yeah, that's very important. If you don't have that in place, then you cannot go for the next phase. And then that's maybe something that I see more often than you think, that you are here, many of your colleagues are still here because they don't understand where you are, or they don't want to follow where you are. You try to improve what you are doing, but actually you're making the gap even bigger. So I think that's the first step. Make sure that you're on that level already. The next step would be, okay, if there are a number of things that we can improve on, let's decide on, because I hear something like who would be the process owner, or is it the product group, or whatever. If you don't, well, you cannot jump in one step. So you have to pick, probably, if it's a very big organization, a segment, a business unit, I don't know what, that can help you in defining and reassessing your next level in maturity. Of course, there will be systems involved in there to support it. So also that can be something that is limiting the possibilities of implementing a kind of a pilot or whatever. But all those elements should be taken into account. And then, well, the biggest question to put on the table is, are we clear on the direction that we want to go and the value that we want to achieve by S&OP? Is it an improvement? Sorry for this. Is it an improvement, which I see very often happening on the S&OE level? Are we seeing that whatever we have in the S&OP and executive S&OP meetings and so on is actually not executed properly or not translated properly to our executions? Then maybe that's the next thing we need to look at. But if there's no strategy on top, if that vision is not clear, well, you could ask yourself, well, what do I need to do here? I just need to make sure they are efficient, they are optimal, that maybe with some technologies like that, all that Internet of Things, well, some of them are maybe appropriate to improve these kind of operations. But if I don't have a direction set to them, I can S&OP whatever I want, I can mature whatever I want, but I will not be able to support a consistent improvement in my company. So this is also a question. Do you have that in place? And more than this pancarte, this poster on top of the above the coffee machine, do you really have something like that? And is it translated via financial measures, via S&OP, and checked via benchmarking, to make sure that you are setting the right objectives. Yes. So first, does everyone understand the S is? Secondly, if that's not the case, train them properly, test that. If it is the case, well, does everyone know what are the possibilities in the different 2Bs that can be achieved? If not, again, train them properly, inform them, organize workshops, get them together, get them thinking on that, and educate them. And then I think by itself, it will become a bit more clear where you want to go to. If it's just an operational improvement, then I'm not entirely sure that you're growing in maturity. I'm not sure if this is really answering your question, but it's also a little bit always very dependent on your culture. How big a company are you? How layered is your company? How are you organized? And also, what kind of company are you? Are you commodity? Are you, I don't know. That's also a part of the equation. Hope it helps a little bit. Doesn't really give an answer, but there's no such thing as a one size fits all answer on this one. Okay. I'm going to keep this as the last question for today, for this webinar, if you don't mind. I hope it was useful for you. Just a few basics, just a few crucials, but maybe it gives you an idea why it is different from S&OP, which is very basic, why it is even different from integrated business planning, which is the new buzzword out there, and why we think it is vital to be able to translate your strategic needs, to have a strategy, to translate it through certain KPIs and very well monitored targets through your S&OP level to your execution level. If we cannot properly do that, then we're in for a tough ride. If you need some support or if you want more information or if you want to have some more extended explanation on this, there's a number of white papers that you can download from our site. There's also Katrin, for instance, or other people in our company that you can contact to, I don't know, have a call, have a meeting, or whatever. That's what we are here for. Hope to see you later, and thank you for your time.